Imagine holding a standard 12-ounce aluminum can in your hand right now.
Okay, got it.
It is, objectively speaking, one of the most mundane, just totally standardized objects on the planet, right?
Oh, absolutely.
Yeah.
I mean, the fundamental shape and function haven't really changed in decades.
Exactly. Yet somehow, the company that manufactured that can, Ball Corporation, ticker symbol Ball, is squeezing 30% more profit out of it today than they did just 5 years ago.
Which is wild.
Yeah.
That's the kind of industrial magic that really demands our attention.
Right. So welcome to another deep dive. We are applying our Talk Tickers philosophy today. The mission is, as always, to bypass the corporate fluff, translate the Wall Street jargon, and, deliver a data-forward, actionable verdict for you, the retail investor.
And usually we try to do that in under 5 minutes.
We do. But, well, the mechanics of what Ball is doing right now are so complex, we just have to take the full, unexpurgated deep dive into their Q4 and full year 2025 earnings call today.
Yeah, we really couldn't fit this into a 5-minute quick hit. There's just too much meat on the bone.
For sure. So, okay, let's unpack this. Because when you look at the raw data, you are confronted with this massive corporate paradox.
Mm-hmm.
On one hand, Ball just reported a massive record-breaking year, record profits, $1 billion in free cash flow.
Oh, $1 billion with the B.
Right. But on the other hand, beneath those shiny numbers, Wall Street is nervously eyeing a looming capacity constraint in North America. They are hitting an absolute physical ceiling.
It's the defining tension of this entire earnings report. You've got this industrial giant operating at a level of, historical efficiency that most manufacturers can literally only dream of.
Yeah, and returning billions to shareholders while they do it.
Exactly. But the forward-looking market, they don't care about last year. They are fixated on this very specific speed bump coming up.
Right, because the market is always looking 6 to 12 months out.
Always. And for anyone managing their own portfolio out there, the critical analysis isn't just clapping for last year's performance. It's about understanding how a company navigates a transition period.
Because based on the math laid out by management on the call, 2026 is going to be a highly anomalous transitional year for them.
Definitely. Specifically regarding their supply chain and their capital expenditure.
Okay, let's start by unpacking that historical efficiency first, because the scoreboard from 2025 is just striking. Let me pull up the headline numbers here.
Go for it.
So full year comparable diluted earnings per share hit a record $3.57.
Which is a 13% increase year over year.
Right. And adjusted free cash flow reached a massive $956 million. That is up 2.4 times from the previous year.
Just a staggering jump in cash.
Yeah. And on the volume side, so the actual physical unit count of aluminum cans they shipped globally, they grew by 6% in the fourth quarter and 4.1% for the full year.
Which, out of context, sounds like decent, steady growth.
Right, but here is where I want to push back, or at least ask the question. Because looking at the broader macroeconomic data for the packaging sector, the overall U.S. can industry only grew by roughly 2% in 2025.
Yeah, it was a pretty sluggish year for the broader industry.
But Ball, meanwhile, grew their North American volumes by 4.8%.
More than double the industry average.
Exactly. So my immediate question is, how are they doing that? Are they just squeezing blood from a stone by aggressively undercutting competitors on price to steal market share?
No, actually. It's definitely not a race to the bottom on pricing. We know this because their margins actually expanded.
Oh, wow. Okay.
Right? When a manufacturer outpaces industry growth by that magnitude while simultaneously increasing their profit per unit, they're legitimately taking market share. They are winning the ground game.
So how are they winning it if it's not on price?
Through product mix and strategic partnerships. The new CEO, Ron, really highlighted their customer portfolio on the call.
Okay, what's in the portfolio?
It is heavily indexed toward the absolute fastest growing beverage categories. So energy drinks, functional waters, and ready-to-drink cocktails.
Oh yeah, the canned cocktail market is exploding right now.
Exactly. They aren't just blindly selling more cans, they're actively selling the right cans to the right brands.
That makes sense.
But the true story of this earnings call requires us to translate the financial terminology they use to describe these results.
Yeah, let's do the Talk Tickers translation, because management loves throwing around comparable diluted EPS and adjusted free cash flow.
Right. When they say comparable diluted EPS hit $3.57 and adjusted free cash flow near $1 billion, what they're really saying is that Ball is becoming ruthlessly efficient.
So they are making more pure profit on every single aluminum can they produce.
Yes. They are keeping significantly more cash in the bank. You have to look at the gap between their volume growth and their earnings growth.
You mean the 4.1% global volume growth versus the 13% earnings growth? Like, they are selling 4% more physical product, but making 13% more money on the bottom line. That's a huge disconnect.
It is. And that gap is the mechanical definition of operating leverage.
Break that down for the listeners. What does operating leverage actually look like on a factory floor?
Well, in heavy industrial manufacturing, your fixed costs are enormous. The factories, the massive cupping presses, the body makers, the ovens that bake the labels on.
All the heavy machinery.
Right. It costs millions before you even make a single can. So when a plant is running at, say, 85% capacity, a huge chunk of your revenue just goes to covering the mortgage and the baseline energy bill.
Just keeping the lights on.
Exactly. But when you push that plant to 95% or 98% utilization, almost every single incremental dollar of revenue falls straight to the bottom line as pure profit.
Because the mortgage is already paid.
You nailed it. You don't need to build a new factory to sell that extra 4% of volume. You just need to run the existing lines faster with less downtime.
Okay, so when they use jargon like comparable diluted EPS, that's just stripping out the one-time accounting noise to show us this core operating engine humming along.
Right. And adjusted free cash flow is the ultimate truth teller in finance.
How so?
It is the cold, hard cash left in the bank after paying for every raw material, every utility bill, every worker, and every piece of maintenance required to keep the business running.
So seeing that free cash flow jump 2.4 times year over year, that just proves their operating leverage is dialed in to an extraordinary degree.
It proves they're extracting maximum value from their existing assets.
Which implies a level of operational control that goes way beyond just, getting lucky with a few energy drink partnerships.
Oh, absolutely.
Because you don't accidentally expand your profit can by over 30% since 2019. And management spent a significant portion of the call crediting this to something they call the Ball Business System.
Yes, the BBS.
Right. And I have to admit, at first glance, a phrase like that sounds like standard corporate consulting fluff, like a branded buzzword for trying really hard.
Right, like synergy or something. But the way they discussed its implementation on the call suggested something far more rigid.
Yeah, it sounded intense. How rigid is it?
It is rigid to the point of being algorithmic. The Ball Business System is fundamentally a proprietary adaptation of lean manufacturing principles.
Okay.
And they apply it globally across 67 different production facilities. Ron detailed how this creates just absolute stability and standardization.
But how does standardizing things actually generate a 30% profit increase? Walk me through the microeconomics of that.
Think about the speed of a modern can line. They produce thousands of cans per minute.
Thousands. A minute?
Yes. At that velocity, microscopic inefficiencies cost millions of dollars. If a line goes down for just 15 minutes to change tooling for a different can size,
you've lost tens of thousands of cans of production.
Exactly. Or think about the spoilage rate. That's the percentage of cans that fail quality control and have to be melted back down. If that rate increases by even a fraction of a percent, the margins literally collapse.
Oh, wow. So BBS is essentially just standardizing the mitigation of those tiny micro inefficiencies.
Precisely. Ron gave a really granular example on the call that I loved.
Yeah, what was it?
He said that in every single Ball plant, whether it is in Colorado or Brazil or the Czech Republic, they have completely synchronized their operational cadence.
Meaning everyone works the same schedule.
Down to the minute. A shift handover meeting happens at exactly 6 a.m. A daily management operations meeting at 8:30 a.m., a pulse check at 1 p.m., and the exact same structure for the night shift.
That is incredibly strict.
It is, but by standardizing the daily routine, they standardize the data collection.
Ah, okay. I see where this is going.
Right, so if a plant manager in South America figures out a way to reduce the changeover time on a seamer machine by, say, 3 minutes.
They don't just keep it to themselves.
No. That data is captured, verified, and pushed out as a standard operating procedure to the other 66 plants within days.
That's amazing.
It's the compounding effect of shared knowledge. Management actually set a target to extract $500 million in cost savings out of the business over a 4-year period using this exact system.
500 million. And how far along are they?
They are currently 2 years in, And they have already realized over 2/3 of those savings.
Well, that definitely explains the $1 billion in free cash flow. They aren't just selling more volume. They are systematically eliminating the friction costs of producing that volume.
Exactly. They are optimizing the machine.
Okay, let's look closer at the demand side of the equation, specifically in North America, because that 4.8% volume growth we talked about didn't come from legacy soda brands, right?
No, legacy soda is pretty flat.
You mentioned energy drinks earlier, and honestly, it's impossible to ignore the physical footprint of these products right now.
Have you been to a convenience store lately?
Literally yesterday. And if you look at the coolers, the energy drink and non-alcoholic functional beverage sections are just expanding wildly, pushing traditional sodas to the side.
Yeah, shelf space is shifting dramatically.
And almost all of these new entrants, these functional waters and energy drinks, they are utilizing aluminum packaging.
Which is a massive structural tailwind for Ball. Energy drinks, ready-to-drink coffees, hard seltzers. These are highly, highly lucrative for a packaging supplier.
Why are they more lucrative than a regular soda can?
Several reasons. First, they rarely use the standard commoditized 12-ounce squat can.
Right, you never see a Red Bull or a Celsius in a regular Coke can.
Exactly. They use 16-ounce formats or slim cans or sleek cans. These specialty formats carry a premium margin.
Because they're harder to make?
Because they require more specialized manufacturing lines, and they allow the beverage companies to differentiate their products on the shelf. They're willing to pay a premium for that differentiation, and Ball captures a piece of that.
Okay, that makes total sense. What's the second reason?
The velocity of innovation in these categories is just staggering. Beverage companies are constantly reformulating, launching new flavors, doing limited edition runs.
Right, there's a new Ghost Energy flavor every week, it seems like.
And Ball integrates deeply with these brands. They essentially act as an outsourced R&D packaging arm. When a major energy drink brand wants to launch a new line with a tactile matte finish or maybe a resealable end, Ball is the partner engineering that solution at scale.
So they aren't just a vendor, they're entrenched in the product development.
Completely entrenched.
Okay, this brings us to a really fascinating point about capital allocation. Because Ball is generating a massive amount of cash from this efficiency and this premium product mix.
We established the $1 billion in free cash flow, yeah.
Right. And in 2025, they returned $1.54 billion to shareholders.
A staggering amount of capital return.
They paid out dividends, sure, but the bulk of it, $1.32 billion, was deployed purely for share buybacks.
Yep.
Now, any investor knows that share buybacks reduce the overall share count. It's like a snowball rolling downhill. By constantly buying back stock, they artificially increase the slice of the pie for the retail investor holding the stock.
Making each remaining share intrinsically more valuable.
Exactly. Over the last 2 years, Ball has reduced their outstanding shares by a staggering 16%. But we need to look at the mathematical discipline driving this, because they aren't just blindly buying stock, are they?
No, not at all. And this is a huge takeaway from the call. Throughout the presentation, the CEO, Ron, and the new CFO, Dan, anchored literally every single financial decision to an acronym.
EVA.
Yes, EVA, or Economic Value Added.
Okay, break down EVA for us, because they repeated it constantly.
EVA is the absolute foundation of Ball's corporate philosophy. They actually refer to it as their North Star.
Okay.
For a retail investor evaluating a management team, understanding EVA is critical because it dictates exactly how your capital is going to be treated by the executives.
So how does the math work?
Essentially, EVA is a performance metric that calculates true economic profit. It takes the net operating profit after tax, and it subtracts a capital charge.
Wait, hold on. A capital charge?
Yeah, that capital charge is the total invested capital multiplied by the weighted average cost of capital, or WACC.
Okay, let's translate that into plain English for the Talk Tickers audience.
Yeah.
That basically means they are acknowledging that money isn't free.
Precisely.
So even if a project generates a positive accounting profit on paper, if it doesn't generate a return higher than what it costs them to borrow the money to finance the project, it actually destroys value.
Exactly. It is a mathematical safeguard against reckless corporate empire building.
Right, because executives love building new things.
Oh, in heavy manufacturing, there is always a huge temptation for executives to build a shiny new billion-dollar factory just to capture a few extra percentage points of market share. It looks great on a resume.
But if the math doesn't work...
Right. If the return on that new factory is 7% and Ball's cost of capital is 8%, the EVA is negative. Under Ball's strict mandate, that project is immediately killed.
No exceptions.
No exceptions. Management will only deploy capital into organic growth, like a new production line, or M&A, like buying a competitor, if it guarantees a positive EVA.
So what happens if they look across the global landscape and just cannot find projects that clear that hurdle rate?
The default action is to return the cash to shareholders.
Which perfectly explains the massive buyback program. If they can't build a factory that returns 10%, but they can buy their own stock at a valuation that implies a 12% yield, they just buy the stock.
It's the most rational use of capital. And by doing so, as you said with the snowball analogy, they are mathematically concentrating the earnings power for the remaining shareholders.
Right. If the company earns the exact same amount of net income next year, but there are 16% fewer shares in existence, the earnings per share automatically increases.
You, the investor, own a larger percentage of the company's future cash flows without having deployed a single extra dollar of your own money.
That is beautiful financial discipline, and that capital discipline directly feeds into the health of their balance sheet too, right?
It does. Because they aren't wasting capital on suboptimal, ego-driven projects, they're generating enough excess cash to simultaneously buy back stock and pay down debt at the same time.
Yeah. Management highlighted that their net debt to comparable EBITDA ratio is projected to drop to about 2.7 times by the end of 2026. And they have a medium-term target of 2.5 times.
That is a fortress balance sheet.
Let's define EBITDA quickly in this context, just so we're all on the same page. Earnings before interest, taxes, depreciation, and amortization. Why is that specific metric so important for a packaging company's debt profile?
Well, in a highly capital-intensive industry like aluminum manufacturing, EBITDA is utilized as the primary proxy for operating cash flow. It shows how much raw cash the core business operations are throwing off before you account for non-cash accounting charges, like the depreciation of those massive factory machines we talked about.
So a net debt to EBITDA ratio of 2.7 times simply means that if Ball took every single dollar of operating cash flow they generated, it would take them 2.7 years to pay off their entire debt load.
Exactly. And in the industrial sector, anything under 3.0 times is generally considered highly secure investment-grade territory.
So driving that ratio down to 2.5 times gives Ball an enormous financial buffer.
A massive buffer. If interest rates spike suddenly, or if there is a sudden macroeconomic recession and beverage demand drops, their debt service requirements are easily covered by their baseline cash generation. They aren't going to sweat.
Okay, so this disciplined financial architecture is really impressive, but it's all operating against a backdrop of a massive, slow-moving macroeconomic trend. Management referred to it multiple times on the call as the substrate shift.
Yes, the substrate shift. This is crucial.
And this isn't just about people liking energy drinks, right? This is about a fundamental change in the actual physical materials being used for consumer packaging.
It's a generational pivot.
Because the data points from the call were stark. While the aluminum can industry grew 2% in the U.S., competing substrates, specifically PET, plastic, and glass, saw volume declines of more than 2%.
The substrate shift is the long-term structural tailwind that basically ensures Ball's relevance for the next several decades.
Why is it happening now?
It is driven by two converging forces: consumer preference and corporate sustainability mandates.
Let's talk about the consumer side first.
From the consumer side, the aluminum can just offers superior convenience. It chills faster in the fridge than glass or plastic.
That's true.
It's lighter to carry. It doesn't shatter if you drop it. And it's permitted in areas where glass is strictly banned, like beaches, pools, and stadiums.
But convenience alone doesn't shift an entire global supply chain.
No, it doesn't. The far more powerful force here is corporate ESG, environmental, social, and governance goals.
Right. Because the massive fast-moving consumer goods companies, the major global beverage brands are facing immense pressure from regulators and, frankly, from their own institutional investors to reduce their plastic footprint.
And aluminum offers them an immediate, scalable solution. Aluminum is infinitely recyclable.
Infinitely.
Literally infinitely. An aluminum can that is recycled today can be melted down, reformed, filled with a beverage, and back on a grocery store shelf in roughly 60 days.
Wow, 60 days?
Yeah, and without any degradation in the quality of the metal, you can do it forever.
And plastic doesn't work like that.
Not at all. PET plastic degrades every single time it is recycled. You can only recycle it a few times before it eventually ends up in a landfill or the ocean.
And what about glass? Glass is recyclable.
It is, but glass is incredibly heavy, which means it requires massive amounts of energy to transport. The carbon footprint of shipping glass is huge. Plus, it has a surprisingly lower recycling recovery rate in many municipalities because it breaks and contaminates the recycling stream.
So as the global beverage giants publicly commit to reducing single-use plastics by, 2030 or whatever their targets are, their most viable path to actually hitting those targets is transitioning their portfolio into aluminum.
Exactly. Ball isn't just riding some temporary consumer fad here. They are positioned as the primary enabler for global corporations to meet their environmental mandates. That is a very powerful place to be.
Which provides a really natural pivot for us to look at how Ball is capturing this demand globally. Let's move into Section 3, management guidance for 2026 and beyond.
Let's do it.
Looking at the international segments first, the story is overwhelmingly positive, particularly in EMEA, Europe, the Middle East, and Africa. Management announced they are projecting volume growth there that will significantly exceed their long-term target of 3 to 5%.
Yeah, they are expecting a real acceleration in Europe.
And the primary driver for this acceleration isn't just organic growth, right? It's an EVA-driven acquisition. Ball recently closed a deal to acquire 2 beverage can manufacturing facilities from a competitor named BenePak, located in Belgium and Hungary.
This BenePak acquisition is a textbook example of that EVA discipline we were just talking about in action.
Walk us through the strategy behind it.
So Ball was facing a major constraint in Europe. They were operating at the absolute maximum of their capacity limits. They simply could not fulfill all the incoming demand from their European beverage customers.
So they needed more cans. Historically, what's the solution to that?
Historically, a company would do a greenfield expansion, meaning buying an empty plot of land, pouring concrete, ordering the machinery, and building a brand new plant from scratch.
But that takes years.
Exactly. Greenfield projects take years and expose the company to construction inflation, permitting delays, and the cost of capital drag, while the plant sits there generating absolutely no revenue.
So instead of building, they surveyed the landscape and just bought existing assets. But the CFO, Dan, made a really interesting comment on the call about this. He said they acquired these BenePak plants at a valuation that was well below replacement cost.
That is the key phrase of the entire acquisition, replacement cost.
What does that mean in this context?
Replacement cost is the estimated capital it would require to build an exact replica of an asset at today's prices.
Okay.
By acquiring the BenePak plants for less than what it would cost to build them today, Ball essentially bypassed the insane inflationary pressures of the last few years.
So they got a deal.
A huge deal. They acquired immediate physical capacity, the actual steel, the building, the machinery at a discount. Furthermore, the geographic footprint of these 2 plants is highly strategic.
Right, Belgium and Hungary. Why those 2?
The facility in Belgium gives them immediate density in Western Europe. It's close to major brewing hubs and distribution networks, which cuts down on freight costs.
And Hungary.
The facility in Hungary positions them perfectly to capture the accelerating substrate shift we just talked about in Eastern Europe. That's a market that is adopting the aluminum can at a very rapid pace right now.
Okay, but there is a caveat to this acquisition, right? Regarding the timeline of its profitability.
Yes, a very important caveat for anyone modeling earnings for this year.
Because management was very transparent that these 2 plants are not going to be immediately accretive to the bottom line in 2026. The CFO noted that while the plants will produce roughly 1.7 billion cans this year, their contribution to operating earnings will be essentially flat.
Yeah, 0 profit contribution for the first year.
So why acquire capacity if it's not going to make you any money for the first 12 months?
Because of the integration curve. These are relatively new facilities that, under BenePak's ownership, were never run continuously at the massive scale that Ball requires.
So they aren't up to Ball's standards yet.
Not even close. This is where the Ball business system comes back into play. You don't just hand over the keys and magically expect the plant to operate at Ball's 30% enhanced margins.
Right. The new employees don't know about the 6 a.m. synchronized meetings yet.
Exactly. Ball has to send in their integration teams. They have to upgrade the software. They have to physically calibrate the machinery to Ball's precise tolerances. And they have to hire and train the local labor force on the BBS methodologies.
That sounds expensive.
It is. Plus, they have to establish their own supply chain logistics for the aluminum coil and the chemical coatings. During this entire integration phase, the operating costs are abnormally high, and the throughput, the amount of cans actually coming off the line, is much lower than optimal.
So 2026 is entirely about absorbing these plants into the network.
Right. It's an integration year. The real financial leverage, the moment when those 1.7 billion cans start generating Ball's standard premium profit margins that unlocks in 2027.
Okay, so Europe is structurally sound, leveraging an acquisition for a big 2027 payoff. Let's look further south. Let's talk about South America.
South America is always an interesting region for packaging.
Because it's historically a much more volatile market, right? Heavily influenced by currency fluctuations and political instability. Yet management is projecting volume growth at the low end of their 4% to 6% long-term range.
Which is solid, steady growth.
But more impressively, they cited a 2.5 times operating leverage in the region, meaning their earnings in South America are projected to grow 2.5 times faster than their physical volume.
That is a phenomenal metric. The South American market, specifically Brazil, is deeply entrenched in the aluminum can substrate, heavily driven by the beer sector.
Brazilians love their canned beer.
They really do. And that 2.5 times operating leverage indicates that Ball has effectively right-sized their footprint down there.
What does right-sizing mean in this context?
It means they spent the previous few lean years optimizing their plant network. They probably idled some older, less efficient lines and consolidated all their production into their absolute most efficient modern facilities.
Okay, so they trim the fat.
Exactly.
Yeah.
So now as the volume slowly creeps back up, every new order is flowing through a highly optimized network, which generates outsized margin expansion.
And there is a massive macro catalyst on the horizon for South America that we have to mention.
Yes, the upcoming FIFA World Cup.
Right. In markets like Brazil, massive global sporting events trigger profound spikes in beverage consumption, predominantly in beer and energy drinks.
Huge spikes. Historically, packaging suppliers see a significant volume pull forward in the quarters leading up to these events as the big beverage brands aggressively build up their inventory to meet the demand.
So even though management didn't base their entire regional guidance on the World Cup, it serves as this highly probable upside catalyst.
Right. It's the wild card that could easily push their growth from the low end to the high end of that 4 to 6% range.
Which brings us, inevitably, to the core issue of this entire deep dive.
The elephant in the room.
The elephant in the room. We have a pristine balance sheet, massive share buybacks, a strong European acquisition strategy, and great South American operating leverage. But the entire narrative of this earnings call hinges on what is happening in their largest, most profitable market, North America.
Yeah. This is where things get really interesting and slightly concerning for the short term.
Because during the Q&A portion of the call, an analyst asked about North American volume projections, and the CFO stated plainly that the region is effectively sold out.
Sold out.
They are operating at maximum capacity. As a result, they are guiding North American volume growth to stall at the absolute low end of their 1% to 3% target range for 2026.
This is the paradox we discussed at the very beginning of the show. It is the problem of overwhelming success.
Explain that. How is being sold out a problem?
Because Wall Street demands growth. Ball grew their North American volumes by nearly 5% in 2025. In doing so, they completely absorbed every ounce of latent, unused capacity in their entire network.
So every line is running 24/7.
Every line is running. But in heavy industrial manufacturing, you cannot simply flip a switch and create 5% more capacity out of thin air. It requires heavy capital expenditure, and more importantly, it requires time.
But the physical capacity constraint is only half the problem here. The other half is a very specific self-inflicted cost burden that management outlined.
The $35 million headwind.
Yes, a $35 million cost headwind that will hit the North American segment specifically in 2026. We need to dissect this $35 million because it is the primary reason the stock might face turbulence this year.
Let's break it down. It's essentially split into two distinct operational buckets.
The first being a supply chain reorganization related to tariffs.
Right. And to understand the tariff issue, you have to understand the anatomy of how an aluminum can is actually made.
Okay, give us the engineering lesson.
A can is not manufactured as a single piece. The main body of the can, the cylinder that holds the liquid, is formed in one process. But the lid, which the industry calls the N, is manufactured entirely separately.
The N with the pop tab on it?
Yes. Ends are incredibly complex. They require a different, much harder alloy of aluminum to support the pressure of the carbonation inside the can and to handle the mechanics of the pop tab tearing the metal.
Okay, so they're made separately, but how does that relate to tariffs?
Because ends pack very, very densely. You can fit millions of them in a single shipping container.
Oh, because they're flat.
Exactly. Because they are flat, it is economically viable to manufacture them in lower-cost labor markets and ship them globally to the filling plants.
Which is why Ball has historically manufactured a significant portion of their ends for the North American market down in Mexico, and then shipping them across the border to be seamed onto the can bodies at their U.S. plants.
Correct. But the geopolitical landscape is shifting rapidly. With the escalating rhetoric and the actual implementation of cross-border tariffs, the calculus of manufacturing in Mexico and importing to the U.S. is deteriorating.
The taxes are eating the margin.
Right. To insulate themselves from sudden punitive tariff spikes, Ball is proactively domesticating this production. They are physically relocating end manufacturing modules and capacity out of Mexico and into the United States.
And moving heavy industrial equipment across international borders, reinstalling it, testing it, and securing a new local supply chain that is not cheap.
Not at all. That supply chain reshuffling generates significant one-time transition costs, which account for the first portion of that $35 million headwind. And they noted it will be heavily weighted in the first half of 2026.
So they are taking a deliberate financial hit today to eliminate a geopolitical supply chain risk tomorrow.
Exactly. It's a risk mitigation strategy.
Which is a sound long-term strategy, absolutely. But Wall Street hates short-term costs.
They despise them.
And that's just the first bucket. The second and larger bucket of that $35 million headwind is tied to solving the actual capacity constraint we talked about. They are sold out, so they have to build a new plant.
Yes, specifically, a massive state-of-the-art facility in Millersburg, Oregon.
Millersburg is the strategic unlock for North America, right? Locating the plant in Oregon positions them close to major beverage fillers in the Pacific Northwest.
Right, which minimizes the freight costs of shipping empty can bodies to the customer. Because shipping an empty can is essentially just paying to ship air.
That makes sense. But bringing a greenfield plant online, building from scratch, is one of the most capital-intensive and margin-dilutive phases a manufacturing company can go through.
It's brutal on the income statement. This isn't software. You can't just push an update and start generating revenue.
Walk us through the mechanics of those startup costs. Why does it cost tens of millions of dollars before the plant even sells a single can?
It's the commissioning phase. Months before the plant is commercially operational, Ball has to hire the entire workforce, hundreds of specialized engineers, technicians, and operators. That is a massive payroll expense generating zero revenue.
Just training people.
Right. Then comes the physical testing. They run millions of feet of expensive aluminum coil through the body makers, the printers, and the ovens, intentionally generating scrap metal just to calibrate the machinery to the extreme tolerances required by the Ball business system.
So they're literally just making garbage cans for months to tune the machines.
Yes. And then they have to undergo rigorous qualification runs with their beverage customers to prove the cans meet quality standards before the customer will buy them. All of these raw materials, energy costs, and labor hours hit the income statement as a direct expense.
And management indicated these startup costs will peak in the second half of 2026. So, summarize the North American picture for me. We have a market that cannot physically sell more volume while absorbing transition costs for moving equipment out of Mexico and absorbing heavy startup costs for the Millersburg plant.
It leads to a very stark mathematical reality for the year.
Right. During the Q&A, analysts aggressively modeled this out and asked management point blank, does this mean North American operating earnings will be flat or even slightly down for the entirety of 2026?
And management, to their credit, did not dodge the question at all. They confirmed it. They said 2026 is a transition year. The earnings growth engine in North America is hitting a pause.
Wow.
They are purposefully digesting these costs, the $35 million headwind, to rewire the supply chain and construct the Millersburg facility. Millersburg will only begin producing commercial revenue-generating cans at the very tail end of 2026.
So the true return on invested capital, the point where Millersburg transitions from a massive cost center to a massive revenue generator, does not occur until 2027.
Correct. 2027 is the inflection point.
Which brings us to the core of our deep dive. Section 4, the bottom line.
The verdict.
We have analyzed the record efficiency, the EVA capital discipline, the global substrate shift, and the North American bottleneck. It is time to deliver the actionable verdict. For the retail investor evaluating Ball stock today, is this Q4 earnings report a bullish or a bearish signal?
When you look at the structural integrity of the company, the verdict is unequivocally bullish.
Okay, bullish.
However, that bullishness is highly conditional on your personal investment timeline. You have to bifurcate the analysis based on whether you are currently holding the stock or looking to initiate a new position.
Let's address the current shareholders first. If I have held Ball in my portfolio for the last 2 years, I've enjoyed the ride-up. But now I'm staring down a year where their biggest market is facing flat earnings and $35 million in transition costs. Do I take my profits and sell?
No. If you hold the stock, you maintain the position.
Why? Why not sell and buy back later?
The fundamental reason you do not sell through a transition year like this is the sheer strength of their defensive moats, primarily their pricing power.
Explain that.
During the Q&A, several analysts attempted to poke holes in their margin sustainability, pointing to massive macroeconomic inflation globally. They cited skyrocketing natural gas prices in Europe and severe inflation in the chemical coatings used inside the cans.
Right. If you are running massive ovens to bake the coatings onto billions of cans, a spike in natural gas prices should theoretically crush your profit margins.
It would, absolutely, if Ball operated on fixed-price contracts.
They don't.
Management reiterated that their business model is built on rigid pass-through contracts.
Pass-through contracts, meaning what exactly?
Ball essentially operates a tolling model. If the London Metal Exchange price of aluminum spikes, or if regional natural gas prices double, Ball does not absorb that margin compression.
I had to pass it on.
Their contracts dictate that those raw material and energy cost increases are mathematically passed directly through to the customer, the beverage brand on the invoice.
So Ball is structurally shielded from commodity inflation.
Completely. They are strictly selling the value-added service of converting the metal into a can. They don't take the commodity risk.
That is a phenomenal defensive mechanism. But what happens if the overall market experiences a multiple contraction, or if Wall Street just gets annoyed with the flat North American earnings and starts aggressively selling the stock?
That is where the second defensive moat comes into play. The relentless share buyback program.
The snowball.
Right. We discussed earlier that they have already retired 16% of the float. Well, management has committed another $600 million specifically to buybacks in 2026 alone.
Which creates a massive artificial floor underneath the stock price.
Exactly. If impatient institutional investors start selling off the stock because of the 2026 transition narrative, Ball's management is sitting there with $600 million in cash, ready to absorb those shares at a lower valuation.
Which only accelerates the EVA accretion for the remaining shareholders who hold on.
The buybacks act as a constant shock absorber against market volatility. So if you own it, you hold it, you reinvest the dividend, and you let the financial engineering work in your favor.
Okay, that makes absolute sense for the holder. The inflation shield and the buyback shock absorber provide a lot of safety. But what if I am on the outside looking in? I see a company with a pristine balance sheet, but I also see a dead money transition year ahead. What is the actionable strategy for the potential buyer?
If you're considering initiating a position, you must adopt a 2027 mindset.
2027.
Because the North American earnings will be muted by the $35 million headwind, and because the BenePak plants in Europe are undergoing integration and won't be immediately profitable, the stock price is highly likely to experience periods of stagnation this year.
Right. Wall Street operates on a quarterly basis. They lack the patience for 18-month capital expenditure cycles.
They absolutely do. Therefore, this is not a momentum trade. You aren't buying for a pop next week. This is a classic wait and accumulate strategy.
Meaning you don't back up the truck and buy a full position tomorrow morning at the open.
Exactly. You utilize the expected sideways trading action of 2026 to your advantage. You initiate a starter position, and you methodically accumulate shares on any broad market dips or earnings reactions where impatient funds sell off.
You are buying the stock today specifically to position yourself for the inflection point in 2027.
Because 2027 is when the mathematical friction finally disappears.
Walk us through that 2027 unlock one more time to solidify the thesis.
In 2027, the $35 million headwind from the Mexican tariff relocation and the Millersburg startup costs vanishes from the income statement. It's a one-time thing.
Gone.
More importantly, Millersburg flips from a cash drain into a fully operational high-margin revenue engine, instantly solving the North American capacity constraint.
Giving them the volume they need.
Simultaneously, the BenePak plants in Europe finish their Ball business system integration and begin generating normalized profit margins. You are buying the stock in 2026 to capture the massive earnings unlock that is mathematically scheduled for 2027.
That is the definition of an actionable data forward thesis. You are buying the capacity unlock.
Exactly.
But before we completely wrap up this deep dive, there is one final provocative thought we need to address. It was a moment buried deep in the analyst Q&A that almost felt like an afterthought, but it hints at a potential existential threat to Ball's entire business model.
Yeah, this was a really interesting wrinkle. It revolves around the concept of backward integration.
Right. An analyst brought up a recent move by Anheuser-Busch InBev, or ABI, which is one of the largest brewing conglomerates on the planet. ABI recently repurchased a stake in a company called Metal Container Corp.
And Metal Container Corp is a captive can manufacturer.
Essentially, ABI owns the factories that make the cans for their own beer.
Right.
Now, when the analyst asked Ron, the CEO, if he was worried about this trend, he completely brushed it off. He framed it as a non-event, stating that the capacity was already existing in the market, that Ball still maintains a deep partnership with ABI, and that generally, beverage companies want to allocate their capital toward marketing and selling drinks.
Not the heavy, capital-intensive grind of manufacturing aluminum packaging.
Exactly.
And in the short to medium term, Ron's assessment is entirely correct. Operating a can line is incredibly complex, as we've seen with the intricacies of the Ball business system. Most beverage companies simply do not possess the operational DNA to do it efficiently.
However, if we zoom out and look at the broader trajectory we've discussed today, a slightly different picture emerges. Ball has increased their profit per can by 30%. They are generating nearly $1 billion in free cash flow. They operate with ruthless efficiency.
Yes.
But at a certain point, their customers, the massive beverage conglomerates, are going to look at Ball's margins. As the substrate shift accelerates and companies like Coca-Cola or Pepsi become overwhelmingly dependent on aluminum, the volume of cans they require will be astronomical.
Which raises the ultimate theoretical risk. At what point does a beverage titan run their own EVA calculation and determine that the margin they are paying to Ball is simply too high?
Right. If Ball's making 30% more profit on the exact same 12-ounce can, that is margin that the beverage company is losing out on.
Exactly. It forces you to question the ultimate durability of the moat. Is the Ball business system, with its 67 standardized plants and algorithmic efficiency, truly impenetrable?
Or will the sheer gravitational pull of the beverage giants eventually compel them to bypass the middleman, absorb the massive capital expenditure, and integrate can manufacturing directly into their own supply chains?
It's a massive what if.
It's not a risk for 2026 and probably not for 2027. But if you are holding this stock for the next decade, the threat of backward integration is the specter looming on the horizon.
It's something you have to at least monitor.
Well, we have covered immense ground today, from the mechanics of operating leverage and the strict discipline of EVA, through the geopolitical maneuvering of the BenePak acquisition and the Mexican supply chain, all the way to the $35 million North American bottleneck that defines the 2026 transition year.
A true deep dive.
You now possess the underlying logic and the actionable framework to navigate Ball Corporation's trajectory. Thank you for joining us on this extensive deep dive. We will see you next time.